Do you have a friend who has a friend and you can't get rid of that friend, and your relationship with your friend depends on you being friends with the other person? I know the feeling, especially anyone who bought a home with an FHA loan. You wanted the home, and what comes with a home on an FHA loan? Mortgage insurance premium. What's going on, guys? My name is Minh with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. And tonight we are going to go over the right way to remove mortgage insurance premium on an FHA loan. If it's your first time tuning in, do me a huge favor, hit the subscribe or notification button so you're notified every time we go live or post new content. So the number one question all FHA home buyers ask their loan officer the moment they close escrow: when can I remove my mortgage insurance premium? So before we talk about removing it, we need to identify the two types of mortgage insurance on an FHA loan. Guys, also, if this video brings you any value, save this video and share this video. If you know somebody who has an FHA loan, share this video with them. If you know someone who's gonna buy a home with an FHA loan, share this video with them. Give them the power to remove the mortgage insurance premium. Let's get back into it. FHA has two types of mortgage insurance premium. Of course, the number one, everyone knows about it. It's the monthly mortgage insurance premium. Every time you make a mortgage payment, it includes that mortgage insurance premium. You can't pay it separate. It's included in your monthly mortgage payment. And the second type of mortgage insurance premium is the upfront. So on an FHA loan, there is upfront mortgage insurance premium. It's already rolled into the loan amount. You might have noticed it when you went to go sign your loan docs and you saw there's some huge charge. Why did they charge you this huge dollar amount, but then you saw that they credit it on the closing disclosure? It's because it's rolled into the loan amount. So to get rid of MIP, you can get rid of the first one, the monthly, but there's no way you're going to get rid of the second one. The second one, when you do pay off that loan, that mortgage insurance premium will be paid off as well. Understand there's two types. One of them, that's what we're going to focus our energy on how to remove. And the second one, it's already rolled into the loan. So when you buy a home with an FHA loan, you put 3.5% down. They tack back on 1.75 mortgage insurance premium for the upfront. So now that we know that, how do you get rid of MIP? That is a question I see in my messenger all the time. So there's two ways to get rid of MIP. Automatically, that means it falls off automatically as you make your payments over time. And number two, refinancing. You are changing the terms of your current loan to remove your mortgage insurance premium. So let's talk about automatically first. That's what everyone wants to hear. Everyone's crossing their fingers. They have a low FHA rate. They got FHA. They didn't go conventional and they forgot. Hey, thanks for this low interest rate, but how about this mortgage insurance premium? Is it permanent or will it fall off automatically like it does on conventional? Got your pen and paper? Let's take some notes. For it to fall off automatically, you have to put 10% down when you bought your home with the FHA loan. That means the initial down payment, not 3.5% down, not 5% down, but 10% down on the purchase. So if you bought a home with an FHA loan with 10% down, on the 11th year, your mortgage insurance premium will fall off automatically. It's the only way it falls off automatically in a purchase. You bought it 10% down on the 11th year without refinancing, calling the servicer, doing appraisal, it will fall off automatically. The second way it falls off automatically on an FHA loan is if you did a cash out FHA refinance. So if you have an FHA loan and you did a cash out refinance, you're at 80% loan to value. That means you have 20% equity. I have 20% equity. Why should I have MIP? Because of that risk. They want you to have MIP. It's for 11th year. And on that 11th year, your MIP will fall off. So those are two ways MIP will automatically fall off on an FHA loan. Number one, if you put 10% down on the purchase on the 11th year, it will automatically fall off. Or if you have a cash out refinance FHA loan on the 11th year, the MIP will fall off. But if you did an FHA streamline, the MIP will not fall off because you did not do an appraisal. An appraisal acknowledges your equity position. And with that equity position, it tells FHA your risk and should MIP fall off automatically. Remember, purchase 10% down or more, FHA cash out, not streamline. Hopefully that helps you understand when MIP will fall off on an FHA loan. Now, Let's talk about refinancing it. Should you refinance out of an FHA loan? That you definitely need to talk to your lender. Make sure it makes sense. Remember, typically FHA loans have lower interest rates than conventional loans. So times may change where rates have gone up, and it might be worth keeping your FHA loan with the MIP instead of refinancing it from FHA to conventional, even if you remove the MIP. Not always a circumstance. Definitely talk to your lender. I see a lot of people get excited about removing MIP, and when they get into the process, they realize the payment really didn't change, and they ate up equity with the cost of refinancing when they should have just left their loan alone until rates got better. So don't be in a rush. I just wanted to add that. I'm all about making money, but I'm not all about making money it's going to cause a result of hurting someone else or eating up someone else's equity. If you're a loan officer, you're doing that, phooey on you. Okay, let's get back to it. FHA must refinance from FHA to conventional. That's the only way to do it. If you do not put your 10% down, you have to refinance from FHA to conventional to remove your MIP. So let's start with your standard 20% equity. If you bought a home, after 6 months, you can use the new appraised value on a conventional loan to remove MIP. If you have 20% equity, anytime after 6 months, you can refinance from FHA to conventional and remove your MIP with your 20% equity. If that is the case and your payment actually drops if you do the refinance, definitely it's a good look. Do it. So what happens if you don't have 20% equity? Everyone assumes because we gained so much equity in the past year, 2 years, that you have the 20% equity. Not in all cases. In a lot, yes, but not all. So if you go to your lender and you're trying to refinance, Mr. or Mrs. Lender, I want to refi, I have an FHA loan, I have tons of equity. Go ahead and do the refinance. If they do the appraisal and you don't have 20% equity and rates are low, this is what you can do. Government loans is called MIP. Conventional loan is called PMI. You can get temporary PMI, lender paid PMI, and single premium PMI if you don't have the 20% equity. Let's talk about temporarily PMI. You still make monthly PMI payments until you pay down the house 20% from the original purchase price before you can request the PMI to be removed. If you have 3 to 9% equity, when you refinance from FHA to conventional, you must wait at least 2 years and have 25% equity after refinancing to request the PMI to be removed. If you have 10 to 19% equity when you refinance from FHA to conventional, a lot of rules have changed. Depending on the lender, you may have to wait at least 1 year and have 20 to 25% equity before you can request for the PMI to be removed. So if you want to go with a temporary PMI, it has a lower rate than some of the other programs out there. When you go from FHA to conventional and you don't have the 20%, temporary PMI is good. That means, let's say if rates don't improve, you refinance from FHA to conventional. In time, your PMI will fall off on a conventional. And we gave you the reasons why and how it falls off. So that's temporary PMI. Now let's talk about lender paid PMI. The rate is a little bit higher, but you don't have monthly private mortgage insurance. So there's no PMI payment to make. So you might be saving some money here, even though the rate is higher than the temporary monthly and on the single premium, which we'll go over in a second. Lender paid PMI is when you take a higher rate. In the higher rate, you cover your mortgage insurance, your PMI. So the lender is giving you a higher interest rate, but they're rolling the PMI into the interest rate and they're making that payment for you. So if you go from FHA to conventional and you have 3 to 4.99% equity, you're probably going to have a pretty high rate. If the lender does your appraisal and you have 5% to almost 10% equity, the rate's still high. You want it to have at least 10 to almost 15% equity. You'll have a better rate. But if you go from FHA to conventional and you don't have the 20% equity, but you got 14.99 to almost 20% equity, that's when you're going to get the cheapest lender paid PMI rate. And I recommend this if you have a 720 credit score or better. If you don't, the rate might be a little high. So we talked about temporary private mortgage insurance, lender paid. Lender paid is a great option if you're like, you know what, I don't want to trip over PMI. I'd rather just do lender paid and not see that payment. Remember, the interest rate is also tax deductible. Mortgage interest is tax deductible. PMI is not tax deductible after 2021. Great options if you don't have 20% equity. And our third option to get rid of mortgage insurance premium, if you don't have the 20% equity, when you go from FHA to conventional, single premium mortgage insurance. You pay the insurance premium up up front. So on a $500,000 loan, this loan, not purchase price, loan, the cost is between 1 to 2% of the loan amount. So it can be between $5,000 to $10,000, depending on your equity and your credit. I do recommend, again, you have a 720 credit score or better if you're gonna do single premium. The reason why I like single premium gives you the same rate as temporary PMI. It's a lower rate than the lender paid. So what happens if rates don't get better? At least you got the lower rate with single premium. Let's say values don't go up. If values don't go up, you're going to be stuck paying temporary PMI for a while until you pay it down. Single PMI, you get rid of it and you don't have to think about it. It all depends on your equity level and what you decide you want to do. Everyone has a different strategy on how they want to continue on with their mortgage. I'm letting you know, single premium is my favorite. We did it on our house. We bought our home 10% down, single premium. Now we don't know where values are going to be. We were so close to 20% equity, but we're not sitting here checking, reports every day. Oh, do I have 20% equity? We just paid it at once. Not everyone has that opportunity. We did, so that's what we did. If you have between 3 to 5% equity, the buyouts can be kind of high. That's the truth. Almost 2%. If you have between 5 to almost 10%, it's still kind of high. But if they check your value and you have between 10 to 15, buying out the PMI will be pretty affordable. But if you have between 15, close to 20, it is the cheapest. So if you get a chance to get rid of your mortgage insurance and you have 15% equity or more, I would definitely do it. 10% more, I would definitely do it as well. Between 3 to 10, it all depends on where you feel like the market is going. It might be worth it, it might not. But to me, it's my favorite pound for pound. So that right there, fam, is how you get rid of mortgage insurance premium on an FHA loan. Remember, there's two types. There's upfront and there's monthly. Upfront, you cannot get rid of. It's already rolled into the loan amount. When you refinance out of it, you're going to pay it off anyways. And now monthly, there's automatic and there's refinancing. Automatic, remember, you got to make sure you put 10% down when you bought the home and on the 11th year, it falls off. If you did an FHA cash out on the 11th year, that MIP will fall off as well. Now refinancing, if you have 20% equity, great. You can refinance from FHA to conventional after 6 months of owning your home and get rid of the MIP if you do have the 20% equity. But if you don't, remember, the three ways: the temporarily, where you go FHA to conventional. Once you pay down your house to a certain dollar amount or you gain a good amount of equity, you can remove your MIP. Or we can do lender paid, where it's rolled into the rate, or single premium, which I like. You cover it all at one time. You don't have to worry about it. But fam, that's how you get rid of mortgage insurance premium on an FHA loan. Hopefully this video brings you a lot of value or brings value to someone that you know that has an FHA loan. Please save this video and share this video. And if you are not following me by now, by the time you made it this part of the video, phooey on you. I'm kidding. Please hit the subscribe or notification button so you're notified every time we go live or post new content. All right, guys. Also, if you have more questions, hey, should I do or should I not do it? Give us a call, 714-790-9697. Or you can DM us or message us or email us info@whatsamortgage.com. And don't forget one last thing, follow us on our other platforms on Facebook, YouTube, Instagram, TikTok, and LinkedIn. All right, guys, let's go with some Q&A here. Hopefully this information helps you guys out. Guys, I appreciate everyone who watched tonight. Thank you for everyone who saved this video, share this video, and like this video. All right, guys, we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you guys so much and have a great night.